The Federal Reserve paused its tightening cycle on Wednesday in line with what the markets were expecting, but delivered a more hawkish message than I think people thought was going to come following the meeting. The Federal Reserve left interest rates at 5 to 5.25%, but very much left the door open to more than one rate hike before the end of the year. In fact, the dot plot indicated that the median estimate for interest rates for the rest of this year was for two more 25 basis point rate hikes. Now, one thing we should note here is that the range of estimates for interest rates over the course of this year ranged from no more rate hikes to 4 more rate hikes. So therefore, what the Federal Reserve is effectively saying is we don't really know where interest rates are going to go. So the median, somewhere in the middle, 2 more rate hikes over the course of the rest of this year was much more hawkish than I think the markets were anticipating. And if you go into next year, it's also quite clear that the Federal Reserve is extremely unclear as to what the path of interest rates is going to be, and that will remain the case until we start to see solid progress of inflation moving back to 2%. In terms of what that meant for the markets, well, the markets have priced in that additional hawkishness from the Federal Reserve. You can see that markets are now pricing in one more rate hike at the next meeting in July, around a 70% chance of that hike occurring. But, and this is the important thing, they don't expect interest rates to stay there for the rest of the year. And this is something that the Fed actually alluded to as well. This idea that no one is considering cutting rates this year. Previously, markets had forecast 3 or 4 rate cuts before the end of this year. So that's now effectively been revised out for the markets before they believe the Fed will engage on a quite significant easing cycle in 2024. But of course, all of this is subject to change. We've got a number of more data points to come between now and the next Fed meeting in July. There's one inflation report and one jobs report on this occasion, rather than 2, which we can occasionally see. And hopefully that will start to give us a stronger indication that the trend is moving in the right direction and the path to 2% is a realistic one without the need of any further rate hikes. The difficulty that we have is that with so little data between now and that July meeting, and that's why markets are pricing in a 70% chance of a hike, if the Fed is on course to raise rates at least once more before the end of this year, then you've got to ask the question as to how much will that data actually influence their decision making. I think between now and September, there'll be plenty of evidence that we are seeing significant progress, which will allow for the end of the tightening cycle. It's just not clear at this stage whether the next data over the course of the next month is going to be enough to ultimately convince. And that's the upside risk as far as interest rates are concerned. But what you can say and what you can will get the indication of is if the Fed does pause in July, there's a strong chance that that is then the end of the tightening cycle at that point. And what we've seen in the aftermath of this is a stronger US dollar. We've seen yields creeping slightly higher, potentially especially at the shorter end of the yield curve. And the reason for that is, as I've just alluded to, markets pricing in no rate cuts now this year. So that's quite a significant change to what we saw a few months ago. And that's helped to lift the yields at the shorter end of the yield curve, as I've just alluded to. And the combination of those factors means that we have seen gold take a bit of a dip. And as you can see on this chart, gold was trading in a range between around 1940 and 1980 over the course of the last 3 or 4 weeks. We did see it dip back to the bottom end of that range yesterday in the aftermath of that Fed meeting. And today it seems that we are drifting below that 1940 level. We're currently trading at around 1932. And I think that's really interesting, is that we are breaking below there. We haven't seen a substantial break below there at this stage, but we are drifting below that level. And that therefore is a downside potential risk for this gold price, because that range being broken could be a sign of increased bearishness in the markets. And if that is what we're seeing, then it's going to be interesting to see what the levels we've got to focus on is. Now, if you look at that longer term trend, you can see we've got the Fibonacci retracement on there. That's from the lows that we saw late last year to the highs that we saw in late April, early May. And the 38.2% fib falls just below 1900. So 1900 stands out as a key level of potential support if we do see a move back towards those levels. Below there, though, if we do see a deeper correction in the yellow metal, then the one that really stands out is 1840. That's the 50% Fibonacci retracement zone. But also you can see that 200, 233-day simple moving average band, which the gold market has been quite receptive to, in that we saw it act as resistance when we were trading below, and we've seen it act as support since we've been trading above. And typically the view in the market is that when something's trading above the 200-day simple moving average bands, then it's in bullish territory. If it goes below the 200-day simple moving average, then it's seen to be in bearish territory. So that will, I think, be a key test if we do move back towards those 1840, 1850 levels. But of course, I may be getting ahead of myself here, because we haven't yet seen a substantial break of that 1940 lower zone at this point in time. We haven't seen a daily close below here either, so we could still move back into that trend range over the course of today. We may still end back within that range, and gold may continue to remain choppy between that trading range that's traded in within over the course of the last month. But if we do see a break low, that would suggest that we have moved into a deeper correction territory, that the markets have adjusted to a more hawkish Fed, and they've also adjusted to the reality that rate cuts this year are not as likely as they previously thought.